Hello, everybody, and welcome to another Mortgage Coach webinar. My name is Dave Savage, and it's an honor to help serve the Mortgage Coach community of the nation's best 5% of mortgage professionals who are delivering and helping thousands of realtors, and we're delivering millions of borrower experiences. So thanks for joining us. If you are new to one of our coaching calls or our webinar today, make sure that you connect with us on Facebook, LinkedIn. We record all of our weekly calls and our events like this and we post them on YouTube, so make sure you connect with us there. The way you found out about this probably is you saw this email and it came through. If you're not getting our emails, make sure that you are. As a member of Mortgage Coach, we are always keeping you updated on the calls and the special events like this one. Really excited about this one. We've been getting tons of questions around what's happening in the market, everything from a forecast of what's happening in the market to how can I be a leader when I'm presenting to a group of realtors or when I'm trying to earn the trust and the respect of a borrower. How can I add more value and how can I earn trust faster? So we've got Mr. Dan Rawitch as our special guest today. Dan, welcome to the call.
Thank you, sir. Glad to be here.
Yeah, well, thank you for the daily videos that you create every single day that adds value to the entire Mortgage Coach community. I'm really grateful for that, and I know everybody on this call is really grateful for that.
Great. I appreciate it, and I love doing it.
Right on. So I want to kick off this call with just a statement and a thought that the single biggest incremental opportunity to win more business, it isn't your service or your loan program, but it's the quality of the insight that you deliver as part of your sales experience. I mean, there's a lot of words, it's a bold statement, but it's one that I believe at my core is that if you can deliver amazing insight when you're talking to a borrower, you can teach them something they didn't know. You can share an insight that they're like, this guy really knows the business. That's where you get incremental opportunities. And whether that's a borrower or whether that's a realtor, that's the heart of the Mortgage Coach philosophy, and that's the heart of the RateWatch desktop app. Some of you have this desktop. Hopefully most of you have it installed. If you don't have it installed, I urge you to do it. And if you don't have the administrative rights to do it, Jacob is going to walk you through how you can do that. So a couple key features that I just want to highlight before Dan provides a market forecast and Jacob walks you through how to use everything better is just the concept that you not only know what's happening on a macro standpoint, on a daily standpoint, but on an hourly standpoint. Most home buyers, most borrowers don't really realize that rates don't change daily, they change hourly. So you've got the ability to have this great hourly insight that comes with alerts to keep you updated on the market and to make it so that you can make that visual for people. You can take this simple day watch and integrate it into an email. Again, as I said, we not only have the hourly, but you can look at it monthly, every 3 months. You can look at a macro, and Dan's going to get through that in more details. For all of you that are using Edge on a regular basis, the RateWatch desktop app gives you alerts so that when you send a video rate quote to a home buyer, you know when they watched it, you know how long they watched it. So I just wanted to bring some awareness to this RateWatch app. And if you're on here, you probably know this already, but Dan is creating that daily update. So every day for 4 minutes, sometimes 2 to 3 minutes, Dan is giving you what's happening in the market so that you can bring that insight into your borrower conversations and into your realtor meetings. Not to mention we have Neil providing content, we have Bill Fisher providing content, Bill Hart, Todd Duncan, all kinds of guests providing great video insights. This is part of RateWatch. So I want to hand it off to both Jacob and Dan Rawitch. Jacob, thanks for putting this call together. I know you're going to take it from here, and I know Dan, you're going to provide a bit of an update on a forecast of what's happening in the market. So I'm going to let you guys take it and run, and I look forward to learning some insights.
Great. Thanks, Dave. Jacob, are you going to turn it over? Do you have some stuff to say before I get into my wrap?
Well, let's go ahead and do that. I just want to welcome everybody to the call, members and non-members. Thank you for joining us today. I know a lot of you were able to attend the earlier call this morning, and hopefully you got some value out of that. We do these calls for you guys, so if you have any kind of content that you'd like to see in the future, make sure and let us know over at support@mortgagecoach.com. We're always happy to make sure that you get the content that you need. But with that said, I'm going to pass it to Dan because Dan is the man, and let's hear what he has to say.
Yes, Dan is the man. I don't know about that, but thank you very much. So everybody, thanks for joining the call. I think this is a great opportunity because I can only imagine how many questions Dave and Jacob get on a daily basis. You know, I get a fair amount. And my whole, I guess, purpose in doing this, and I don't remember, Dave, I feel like it's been a good 5 years that we've been doing this together. And the purpose initially between Dave and I was to really demystify all of this bond stuff. Because I don't think people in the capital markets intend to do it. They just have their own language. And so we get caught up in a lot of lingo, and we can't follow it, and therefore we don't. So I try to keep things as simple as I can. Having said that, I'm going to go into a quick forecast. A couple disclaimers before I do that. One, I'm going to go fast because it's an awful lot of information. Two, I'll make these slides available. I'm sure Dave can tell me how to do that, but I'll get them to him after the call. And three, most important disclaimer, these are my personal Dan Rawitch viewpoints. I'm not speaking on behalf of Mortgage Coach. I'm not speaking on behalf of Prime Lending, who I do work for. So I just want to be clear that this is Dan. So if I'm wrong, you can call and yell at Dan. That's it. All right, so let's go. All right, so the first slide is kind of what I would call cause and effect, and it'll set up the rest of the slides. So the following things I believe will happen this year on the left side, the cause, and that will affect the things on the right side of the page. I don't need to read you the bullet points, but generally speaking, I think that we have a pretty good dip. I'm not calling meltdown by any stretch. But I say we have a good dip that funnels through everything from employment to GDP, and also at the same time inflation dips. And the effect of that, in my personal opinion, will be a Dow Jones that corrects at least 5,000 points. That sounds like a huge number, right? But it's a 30% correction. It's not a huge correction. It is if you have all your money in your 401k tied up in it. And I think that rates take a dip that I'm not seeing economists talk about. Every single person is talking about rates getting to the mid-threes by the end of this year. And those of you that have listened to me long enough, I am the ultimate contrarian. I've said this before. My very first economics class, I don't even remember what year in college I was, but it's where I was like, wow, I like economics. I'm gonna stick with this subject. And the professor in that class said, only thing you ever have to remember in life is that the math is always wrong. Always wrong. If you go with the math, you will be broke, or at best you'll be average. And so I said, well, I'm not going to go with the math. So when I see everybody saying 3.5, I don't believe it. And then I start digging for data that supports my contrarian viewpoint. That's how I get where my beliefs. A lot of you will think I'm crazy. That's okay. All I can do is share with you why I think what I think. Because I think some of the marketing pieces that Dave sent out, or Jacob sent out, no one has a crystal ball. I wish I did. I wouldn't be sitting here talking to you guys. Well, I might be via a yacht and a satellite or something, but no, I'm just sitting at my desk. All right, so here we go. Can you guys see my slide? And Dave and Jacob, are you hearing me okay?
You sound great, Dan. I am seeing your slide on cause and effect right now.
Good, thank you. Just checking in.
All right, thanks, Dan.
All right. So I highlighted the months where I see things beginning to change. And so number one, as you know, again, if you've listened to me over the years, inflation is absolutely the number one concern we will always have. Everything else is noise. But if inflation stays low, so can interest rates. I don't believe we can have exorbitantly high inflation without having corresponding higher interest rates, gold prices, et cetera. So I see inflation staying extremely tame through the summer. I do see it just ticking up a little bit, but as you can see here, through the year, we're under the Fed target. We're in great shape. So inflation is not a factor to lower rates. That's number one that I worry about, and I'm not worried about that. Number two, job growth. If job growth becomes too robust, that becomes inflationary historically, not always, but historically, because there's competition for wages, et cetera. And there's a reason why job growth gets robust, and it's because everybody's growing and hiring. And so that whole environment can create a little inflation bubble. I don't see that happening. I see, and by the way, this is the same model I've used for years. This model has been incredibly accurate up until QE. If you listen to my forecast at the beginning of 2013 or end of 2012, I said QE is going to probably push the predictions of my model out into the future a tiny bit. So there's still a little bit of noise because of QE. Let's see what the unemployment numbers come out at tomorrow. The model, is calling 140,000 jobs. It might be a little high. It might be 120, 125. Don't know. We'll see. So we'll see job growth come up a little bit, and then we see it dip. This is part of that summer effect I'm looking for, which is going to create lower rates. Next is retail sales. The same thing will happen as jobs decline, retail sales begin to decline. This is not like a disaster. This is not an economic meltdown. You've heard me talk about those in the past. I think QE has certainly put that aside for the moment, maybe forever, but retail sales will slide, in my opinion. Domestic GDP, same thing. It's going to start dipping down, and I think you're going to see that almost immediately. We'll start seeing the 2s and the 1.8 numbers. Nowhere in here do I see a recession in 2014. I don't want to keep beating a dead horse, but QE is a wild card that none of us can fully understand, including the Fed. So if they just pulled out QE tomorrow completely, does that put us into a recession? I don't know the answer to that. Does Obamacare plus QE going completely away put us into recession? I don't know. Can the Fed continue to float this bubble? Because that's what they've created. They've created an asset bubble with QE, and the Fed's intention is to float that bubble to infinity. Maybe they can. For now, all I'm concerned about is what I can see in front of my face, and I think that we have GDP slipping but not receding into a recession. This is the correction I talked about in a graph form, and this kind of starts happening. Let's see. This is telling you sort of summerish. I told you guys all I got out of stocks. I don't even remember when, but I think it was fourth quarter. Yeah, it was fourth quarter, and I very publicly said I'm out, and I'm out early. I knew I was out early. I'm a pilot, and pilots have a great saying: I would rather be on the ground wishing I were flying than in the air wishing I were on the ground. There's no worse feeling than being caught in a storm 20,000 feet from the ground with ice building on your wings. So that was always, that's how I live my life. I'd rather be on the ground wishing I were flying. I'm happy to watch people take profits. I'm so happy for them. But I'm happy to also be on the sidelines right now. This is coming. This is coming. Whether it's 1 month, 2 months, 6 months, everything corrects. We know that for history. And so graphically, and I'll show you the month by month because it's easier to read, all of this Dow and GDP and all of these things are linked together. What they do is they take us to a very, very low short-term interest rate. Now keep in mind, the Fed controls the Fed funds rate and the discount rate. That's about it. They don't really control much more, but because they control the discount rate, that effectively takes control of the very shortest term securities, the 1 year, the 6 month, the 90-day Treasury bills, et cetera. And so I see this staying incredibly low, as I do Fed funds. Fed funds are, look at this. I mean, the model is saying all through 14, doesn't pick up in 15 or 16. So forget QE. We probably have Fed funds giving us a tailwind as far into the future as I can see. And guys, it wasn't always like this. You remember that, right? I can remember Fed funds rates in the 8, 9, 10% range. Even in 08, we had Fed funds at 3.5. So if nothing else, the Fed is saying rates should stay 3% lower than they were in 2008. I buy that. The 10-year, and again, I do have this broken down monthly. Because of everything that I said, I believe that the 10-year actually dips down, and we have and we get a little tiny look below 2% again. This is where I promise you, people that are probably more schooled, they went to way better colleges, they have PhDs in economics. This is and put me on CNBC in front of any of these guys, and they'll probably make me look stupid. But I passionately believe this forecast happens. I passionately believe it. So on a month-to-month basis, here's what I see. I see, and again, I have to check the model because this model, I ran this back in October, I believe. We were calling for a 286 10-year. I think we were darn close. 270s in February, 260s in March. So the model's working right now. And so if I play that model forward, you can see we start dipping into the very low 2s on a 10-year, and in the mid-215, we actually dipped down into the high 1s, 190-ish. So I'm seeing lower rates than the market is seeing, and I think that's kind of a good thing. Not always for good reasons, right? Because there is that little summer dip here that creates this from happening. And then, of course, the thing you care most about, 30-year fixed-rate loans. I think I have a month-by-month slide. So very similar story here. By end of year, you're probably seeing sub 4% 30-year fixed rate. That's the Freddie Mac contract rate. I think that's probably pretty true. To go backwards, that Freddie Mac contract rate, you know, in 2013, summertime, et cetera, was running kind of 4.5, and then so I see it coming down by mid 3s and even into the low 3s. Is that what I said? No, high 3s. Okay, that's it. That's kind of my economic forecast. And Jacob, I know you had a bunch of questions you wanted to ask me, so I'll let you guide me from there.
All right. Well, thank you very much, Dan. That was some amazing information. I was taking notes. I gotta tell you, and some good stuff. I can't wait to try and put this kind of prediction analysis into action and see what happens over the future.
Me too.
But what I'd like to do right now is I want to show everybody the RateWatch desktop app, because that is what you're looking at on the screen right now that Dan's showing screenshots of. And I want to show you what it looks like when it is actually loaded on your computer. So you guys should be seeing my screen come into view momentarily here. Now, this is the RateWatch desktop app. So you can see that we have candlestick charts here, and each one of them has the ability, you can hover over it and find out exactly what the open and close rates are, how much change there was for the day. And there's a couple of characteristics of the metrics that I want to go over with you real quick. But I do want to remind you that while this is the desktop app, as Dave said earlier this morning, if you don't have admin rights on your computer to be able to install this desktop app, you can actually go to the online app. And as long as you're a Mortgage Coach member, all you have to do is go to ratewatch.com/RateWatch Online, and then you're just going to sign in. And when you do that, you'll actually get a slightly bigger version of the same charts, all the same functionalities that you see on the desktop version, with the exception of the pop-up alerting. So I'll show you that in just a moment here. But I want to kind of touch on some of these analysis points and get a little bit of feedback from Dan on why you would use these, why you would need to change these. So the first thing here is, in RateWatch, we show 3 different agencies, and you heard Dan talking about the Treasury rates. You heard him talking about the Fannie Mae 30-year and the Freddie Mac. Now, Dan, if you would, can you speak to the agencies? If I'm an LO and I'm looking at this and trying to gain a market perspective here, why would I need to change over to some of these other rates versus just following the Fannie Mae? Dan, I think you might be muted. We can't hear you.
Sorry about that.
Oh, there he is. Okay, cool.
Wow. So yeah, that's a great question, and there's both a complicated and a simple answer. And I actually have a slide on the complicated side, but let me start off just more simply. The Treasury market is a vastly larger market than the mortgage-backed security market. You know, it's way larger. And because of that, it's going to tend to be more reactionary. And I believe to a certain extent, it's going to be a little more foretelling of of bond movement than mortgage-backed securities. And so, you know, on a daily basis, if I'm trading, even if I'm trading mortgage-backed securities, I'm really watching the Treasury market first and watching the actions. And the Treasury market trades all night long. You know, it's got the overnight markets, and it's going to react very fast to the Dow. So I personally, and not always, it's not perfect, but I view it as a better foretelling of what's going to happen with mortgages. Does that help?
Excellent. Yeah, that's perfect. Now, Dan, would you say that that is a lag indicator of what you expect to see in the mortgage-backed securities?
I'd say leading indicator.
Leading indicator. Thank you.
Indicator.
Perfect.
And not so much minute to minute, although that can happen, but more out into the future. And so there is a known spread between mortgage-backed securities and treasuries, and that spread is because there is perceived risk in mortgages that exists above treasuries. Why? Because Uncle Sam backs treasuries. They're guaranteed, and they can print all the money they want to back that guarantee. Mortgage backs are not guaranteed. They can fail, right? People can default. And so there's a credit risk between those two bonds. And so that's why treasuries are more real indication of what rates are doing. Mortgage-backed securities have built in all these other factors in terms of how the spread exists. So what I do is I watch that spread between the two, and if it gets too narrow, then I know that something's wrong, and if it gets too wide, I know that something's wrong.
Excellent. That's great perspective. Thank you, Dan. So now I do want to show everybody that in each one of these agencies, you have different coupon values that you can watch in here. And up until recently, we were watching the 3.5 coupon because it was closer to par. We recently switched over to the 4% coupon because we found that a lot of the larger banks' rate desks are actually watching the 4 and reacting to that a little bit faster than they are the 3.5. But I'd like to ask you, Dan, you know, what is the coupon and what does that represent so that our members can understand this?
So if I can have the screen, I made a couple slides to answer that question.
Coming at you right
and
now.
Again, I'm going to try to make this as simple as possible. And the first thing I want to show you, and it plays into your first question and this question. Here's a screenshot of the Ginnie Mae. So for those of you that don't know, Ginnie Mae, those are where FHA securities are sold. Or they're created by Ginnie Mae, and then we have the Fannie Mae. And these charts look very much the same, don't they? Very much the same. But there's one significant difference, and that is, just to give you an idea, the close, let's say yesterday, of the Ginnie Mae was 105.55, and the close of the Fannie Mae was 104.40. Huge difference in price for exactly the same yield, right? So what happens is you have this little thing called, whoops, sorry, let me blow this up, convexity. I'm going to go through this formula. It's a little bit of calculus. It'll take me about an hour. No, I'm not going to talk about that convexity in that detail, but I want you to be aware of the terms convexity and duration because you can sound really smart when you throw them around. But what I'm going to do is I'm going to basically kind of give you an idea of what you need to know about convexity. What you need to know about convexity is that some bonds have higher convexity than others, which means they're less sensitive to rate movement and they tend to trade at higher prices. So Ginnie Mae's, if I go back, Ginnie Mae securities have a higher convexity than Fannie Mae. So they're going to trade higher and they're going to be a little tiny bit less sensitive to rate movement. And so if you take what I just said and you carry it forward into your question, Jacob, is why the different coupons and what is the difference? And what it comes down to, it is this very complicated financial analysis which predicts the duration of a bond. And duration simply means is if I put $1,000 investment into a bond, when am I going to get my $1,000 back? And in some investments, I'm going to get it back faster than others. And believe it or not, coupon rate doesn't have as big of a play in it, but it does have a play in it. So here's just a couple of bullets, and I'm going to talk you through those. Because everybody says, well, why is it when bond prices go up, rates go down, and vice versa? A lot of people don't get that, and they don't explain it to their borrower. So I tried to simplify it in these bullets. But I want you to know there's a little bit more complication in terms of why are we looking at a 3.5 for a 4% bond, and it has to do with the convexity of that particular coupon. Wall Street wants the shortest duration possible, right? So if I invest in a 4%, am I going to get paid back faster than I will at a 3.5%? There are also plays in that prepayment speeds in the mortgages. Is a 4% going to prepay faster or slower? So all the stuff goes into play, and historically, a bond that's probably closest to par, a coupon, had a little bit lower convexity. But guys, it's been a lot of years since I've actively traded on Wall Street, and things do change. What we know right now is the 4% coupon is way more liquid than the 3.5. So that's the bottom line. But it's also very rare that something this far above par would be a more active coupon. All right, so why do rates go up when bond prices go down? Why is there this inversion? So think about it this way. Think about the rate of a bond. That's called a coupon. I want you to think of a coupon as something that you could go to the market with. Maybe somebody says, I have a $2,000 coupon to go buy a car. It's real. You can actually go to the car dealership and give them this coupon, and you can save $2,000. So a coupon is a thing. It's an item. Now think of this coupon as something that you have to buy. So you go out and you use, so I said I got a $2,000 coupon, Dave, but dude, I don't want to give it to you. I love you, but give me $500 bucks. I'll give you my $2,000 coupon. So Dave says, great, I'll do that. So a high coupon has more value than a low coupon, right? Duh. Again, remember, coupon equals rate, but I want you to be thinking coupon for a second. So a seller wants more money for his coupon if he has a high coupon. If I had a coupon with a number 5 on it, wouldn't you think I would want to sell it for more than a coupon with a number 4 on it? Of course I would. So par or 100 means the coupon you are buying is at market rate. So basically every coupon in the world on eBay and everywhere else, every coupon is 3. That's the number on that coupon, 3. So that means the most I'm going to sell my coupon for is 0. That's the market price. So no one's going to pay me extra for my 3 coupon. They're going to pay me par. Now if I have a higher coupon, so if the world was selling coupons for 3 and I had a coupon with a number 4 on it, I wouldn't sell that for par. I'd say, pay up, man. You got to give me an extra. In this example I gave, you got to give me an extra $2 for that coupon. That's where you see these numbers 102. Right now, whatever bonds are trading at 104. That means that 4% coupon is worth more than a 3% coupon. So if I own a bunch of bonds with a 4% rate, I'm not going to sell them for 0. I'm going to sell them for a 102, a 2-point profit. If the market's at 4 and I have a coupon at 3, no one's going to pay me par for that coupon. They're going to discount it. So a coupon becomes less if new coupons come out at higher rates. Rates go down, your coupon becomes worth more. I don't know if that's simple or complicated, but you have to detach the two things. The coupon is a thing, and the price is a thing that you pay for that. So as the coupon goes up, it's worth more money, period. But the coupon you already own, if it's at a lower rate, your coupon becomes worth less. I don't know if that makes sense.
Actually, that was awesome, Dan. I don't think I've ever heard it explained like that, and that's exactly what we were looking for. Thank you.
Yay.
So let me take the screen back for just a moment here, and I want to make people. Okay, good. I want to make people aware of one more part in the chart here that you can adjust, and these are the metrics. So there's moving day averages here, things like 100-day moving average that you can overlay on the chart. And then there's these support and resistance lines. Now, the support and resistance, I get a lot of questions about these through our support box. And I'd like you to speak to this channel, Dan, and why would you put these up on your screen as an originator to monitor this traffic?
Well, that's huge. I actually hate them because they are really good. And they make me look less important or needed. And in fact, I don't put them up when I'm doing my analysis because I want to look smart and do my own. So you guys, I don't know who's on the call that watches the daily video, but if I could trouble you to let me show my screen one more time.
Oh no, absolutely.
I can show you. I'll show you today's and how I drew on that and why. Let's see here. Let me pull up today's. All right. So and I do different things, right? So support and resistance. These are very technical but incredibly simple explanation to it. And the simple explanation is this is where fear and greed lives, right? Right in these lines. These lines are the margins between fear and greed. And I said it so many times to you guys. Let's just say that we were in this trading range, which is where I drew the dotted lines. This is where I believe the next trading range is headed. And so if I want to sell short, if I'm going to like short this market, I'm not going to short it in this trading range. This is where traders get their, you know what's kicked. I will put a sell order in about a quarter point below 104. So about 104, maybe 104, 103.80. Because what I know by looking at this is the next move is probably going to be right around, and by the way, to determine this, it's very simple. It's looking at where the last group of people got scared or greedy, because they're going to get scared or greedy there again, because a bunch of people either bought or sold right here, and they're ready to take the next action when it hits this level again. So these patterns will repeat themselves over and over. And so the ultimate resistance support level is down here. This is where everybody says, hey, this is low enough. When it hits 102.80, I'm buying again. And this number has repeated itself, I think, 4 times now in the last several months. And so there's a lot of comfort down here, a lot of buying up here. And then when it hits this level here, there's a lot of guys like me that say, I'm out. Because the last time it hit 103.30, a bunch of other people got out. I just made a 50 basis point profit. I'm out. So this is how traders trade. They'll look at what's happened in the past, and they'll put in buy or sell orders accordingly. I was always a very low-risk trader. I'm always willing to give up short-term gains for long-term gains. And so, for instance, when I told everybody that my buy order was at about, I think I said 104.30, because I took it right outside of the trading range, and I said if we bust through that, we're going to have a hell of a move. And I also said, by the way, my sell order is at 104.80. Why? Because it just keeps happening here. So that's where support and resistance is. It's really all about psychology, and it's honestly as simple as looking and drawing lines where you see that things have happened. You can see here, this was a support level right here. Can you see my mouse, by the way?
Yes, we can, Dan. Thank you.
Okay, good. So this is a support level at 103. This is a resistance level at 103.60. When we get gaps, any gap up or gap down, if the gap doesn't close, it becomes support on the way down and resistance on the way up. So it's incredibly easy to draw. If we go back to your slide and you look at it now with that framework, you'll see you have primary support and resistance levels and secondary support and resistance levels. And just to keep the terms clear, support means you're going to support me on my way down. Resistance means you're going to stop me on my way up. And when we bust out of a trading range, we usually really bust out.
So Dan, let me ask you, in this morning's, in your commentary this morning on the video, you mentioned that we missed an opportunity with this head and shoulders that we saw yesterday. Can you explain a bit about that kind of a formation and what would that normally indicate?
Yes. So we have a couple examples of head and shoulders. There's not a lot in this chart I'm looking at right now. There's a nice reverse one here, but here's a classic. So the head is right here, left shoulder, right shoulder. And what happens when you see a head and shoulder, and there's a bunch of psychology around that, but I'm not going to go into that much detail right now. Just know that these things usually are fairly accurate. If you fail to close above the right shoulder the following day, that is considered a very bearish move. And so what happened is yesterday we didn't get up there. And when it became clear that the market was losing velocity on the way up toward that shoulder, it created a bit of a panic because everybody said, failed head and shoulder, boom, sold off, created a gap down opening the next day. it doesn't mean that you're going to fall forever and free fall. I haven't really looked today. Actually, let me take a quick look. So it looks like, you know, we had a gap down, but we closed the gap here. We still are really looking at a failed head and shoulder. And what's happening, you want to talk about support and resistance, guys, right here. So I think I said we need to hold 104.30. It's obvious, isn't it? Because we needed to, this is where the support and resistance was. This was a gap. This is a very important level right here. So not only are we sitting on top of a very important support level, we're sitting at the bottom of a failed head and shoulder pattern. So if we bust this today and we close below this level right here, we're going to 104. That's as sure as almost anything I could tell you. So I hope that helps. So that's just one example of head and shoulders. They also can happen in reverse. There was a reverse one, so shoulder, head, shoulder, and it did manage to close above the shoulder, and it took a little bit of time, but boom, it created a significant rally.
Excellent, excellent. Now, Dan, I have a question for you that I've gotten from a lot of our members because they love this terminology, but they have no idea what it means. What is the dead cat bounce you've referred to?
Dead cat bounce, I know it sounds cool, especially if you listen to my RateWatch reporting this morning. I hate to admit it, guys, don't hate, but I love all animals, including cats. Definitely a dog guy, but I love my cat, and she's very sick. So if you were to drop a dead cat from a building, no matter how dead it is, when it hits the ground, it's going to bounce. And so when you look at a free-falling market, you have to say, is this a correction? So we fell big from here, right? Boom, drop a cat from the building, and it bounces. Is that a dead cat bounce, or is it a correction? In this case, it was kind of just a correction. I mean, it was a dead cat bounce. It never bounced above, really, where the cat would have gone up to, and in fact, it fell again. So that's all that means. Everything is going to bounce when you drop it, but that doesn't mean it's a new trend or a correction coming.
Got it.
And I see so many guys get caught up on that. Oh yeah, we fell so much, it's going to correct. Look at that. Look at today, it's correcting. I said, no, it's not. It's a dead cat bounce.
Awesome. Well, Dan, let me take the screen back for just a moment here. I'm going to show people a couple of other elements that are inside the RateWatch that they need to be aware of. So one is, Dan talked about the gap opening this morning, and as you can see on the right side here, it shows, you know, the agency and the coupon that we're following. Now, I should mention that the alerts that you set up in your RateWatch client are alerting on this agency and this coupon. So when you see things like the prior close here, you want to pay attention to that opening bell alert that you get, because it's going to show you how much of a gap there was up or down between yesterday's close and today's open. Now, this number here where you're seeing up 9 basis points, that means we are up since opening bell, but we are technically down since yesterday. So that's why you may have seen some lender repricing already this morning, and that's just basically based on the gap opening this morning. But let me move along to the day watch screen, because I do want to explain what that is, and you know, obviously I want to be cognizant of all your time and not take too much here. But I want to explain that these candlesticks here, as I mentioned in the very beginning, they show the metrics from the top to the bottom, where it opened, where it closed, the highs and lows. But you can drill down into this much further. And to do that, you go into the day watch section. Now, the day watch section, this is what Dave Savage was showing early on in the presentation. And the day watch section allows you to drill down by minute. I mean, you can literally hover your mouse over any point in this graph and find out exactly where these movements happened. Now, today, it hasn't really gone over the 15 basis point mark yet, so we haven't issued any alerts, but you can see exactly how volatile this is trading at. And when you're talking about this with your clients and you're relaying information about the bond market and why it's important for rates, remember that you can always copy these screens. If you're in your desktop client, you right-click on it, hit copy, and then you just paste it into an email. And you can do this with both the day watch and the candlestick charts. So you can see I actually pulled up an earlier day here, 3-4, and there was 2 alerts. That was that big drop day that Dan was talking about earlier. And you can see here that we alerted twice on this. Now, this gives you the opportunity as an originator to let your clients know, hey, I see something coming here that might predict higher rates based on the analysis that I've got in this tool. You know, at this point, it's probably a good idea to lock. So Dan, my question for you, I know you've managed originators for a long time. How do your originators use this type of notification to stay on top and to really ensure that their clients have the best rates possible?
Yeah, great question. I have a general and a specific answer, but I can't resist this because this was so graphic. Remember I told you guys on the chart previously that 104.30 was a key support level? If you look here, or you probably can't see my mouse right now, but if you look at the screen behind the one that Jacob just put up, you can see how it keeps banging on 104.30. Bang, 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 bang. This is a classic support level, and so I suspect today we'll knock on it one more time, and if we hold it, that'll be a very important time. If we break through it, we're into a new territory. So I wanted to get that across. And to that point, this is the type of information that your borrowers can understand. When you say that rates are kind of volatile today, you can see they keep trying to drop below this level right here. I don't know what's going to happen, Mr. Borrower, but if it drops through here, and then I would pull up the graph, and I would say bad things are going to happen. So that's one. Two, I take what Jacob said a tiny bit further. I see loan officers doing this. Scott Nicholson, in my opinion, really made this a great idea and uses it, and I've seen so many people follow it. We use Snagit or Jing. There's a bunch of different screen capture tools. They're so simple. I think Jing is free. So what I would do is I would take that graph, not this one, but the actual bond chart. Yep. And I typically like to have a longer term perspective, but even so, this one's fine. I would take a snapshot of this. I would draw lines. Yep. So what I would do is, and you can just copy my lines. Just stop the video, snag your own, or just snag mine out of the video. This line I drew for you guys, this was a trend line from here to here. This trend got busted 2 days ago. So we're no longer in an upward trend. We're in a downward trend. And the question is, how far down is down? And I'm going to tell you, down is about 104-ish. So Nicholson would take this kind of information, and he would just draw this out, and he would say, in really simple English, we broke the trend for rates improving. They are now getting worse. Now's a great time to lock. So he would, and I'm sure he still does, all day long. He'd snag these things, draw on them, and then type a quick message to the borrower. This is key. This is a key tool. The other thing, by the way, I wanted to say, and I don't know, how other capital markets desks are. I just quickly would compliment, our desk at Prime Lending. It is amazing to me, and really it's the ultimate compliment is to you guys, Mortgage Coach, because what happens is we get an alert from you, and then usually within 2 to 5 minutes, we'll get an email from our desk saying, don't know how much longer I can hold here. We may be having to bump rates. I have yet to see a time when we didn't get the alert from you at least 2 to 5 minutes ahead of our desk, and our desk is good. So, and I'm sure they knew the same time that the system knew, but the point is they're going to wait a little while because they don't want to whipsaw the loan officers. This is non-personal. It's just going to tell you it's coming. And so any loan officer that's floating a borrower that they've got to lock, they've got to get talks out, this is an early warning of saving a borrower an eighth, a quarter, 3/8, a half a point. To me, it's one of the greatest values you bring, except for my video.
Well, I totally agree.
I couldn't resist that.
So a couple more things I want to show you on this day watch chart real quick, and these are, again, both available in the desktop app and on the online version that we're looking at today. There's alerts. Now, I don't have any alerts in here because I'm using a sample, and there wasn't any alerts today. Now, if we actually looked, if we were looking at this yesterday, we'd actually see each individual alert. Now, we alert you when there's a plus or minus 15 basis point change. So you're always going to be alerted when there's a large movement, and that's when you should start paying attention to what's going on because there's probably going to be a change. Now, one of the critical features is figuring out how long it takes your lenders to reprice after an alert. I mean, as Stan said, we're looking at 2 to 5 minutes for prime lending to start going, hey, we're thinking about changing rates here. Now, you need to be eyeballing these charts and finding out how long it takes your lenders to react to a major movement in the market, whether it's positive or negative. You'll find out that positive, if they're going to reduce rates, usually takes a little bit longer than negative when they're increasing rates. They tend to do that a little bit faster because obviously you want to pull the money off the table if it's not as valuable. But you will see these alerts in here. Now, there's also an Edge Views area. Now, for those of you who are members, and I know there's a lot of non-members on this call, but there are a good chunk of members. For those of you who are using the Edge and RateWatch combination, this shows you when any of your Edge presentations are viewed. So you can see it shows the duration of the view. You can catalog these views, and in fact, you can change the view date here. So if you wanted to find out how many views you got on a specific date, come in here, toggle the date, and you can see exactly which of your presentations got viewed and for how long they were viewed. Now, this is critical for striking while the iron's hot. And I'd actually like to ask Dave Savage to speak on this a little bit. Dave, would you mind jumping in and talking about just how critical it is to be monitoring your client interactions, making sure that not only you're reacting to the bond market moving quickly, but you're reacting to your client moving quickly?
Well, I mean, one of the things that I think is so powerful, the way we've designed things to be simple, to be able to cut and paste it and put it into an email, make it visual, so you're not just, telling people what's happening, you're able to demonstrate it. You're able to show them, I know what's happening in the market, and it's visual. So I wanted to get that out. In terms of the alerts and the ability to be, with the client when they need it, let's face it, speed to lead is important. Usually when you're given an opportunity to do a loan for someone, the faster you get to it, the more likely you are to win the business. And let's face it, when you're in that period of time with the client where you haven't locked them down, you haven't got it, to not play phone tag, to be there at the right time is so essential. So to be able to send an Edge report to someone, especially a video rate quote where the realtor is CC'd in the loop, and when they open it and look at it, you know it, and you can call them and follow up. I mean, it's hallmark to being successful at converting home buyers. And right now, when you can convert home buyers, realtors love that, and you're going to do more business. So it makes a lot of sense. Hope that helps.
Excellent. Thank you, Dave. I wanted to bring everybody's attention to this little pop-up that just popped up in my right corner of the screen. Now, we just talked about how your Edge alerts come through. When you have the RateWatch desktop application, it'll actually pop up alerts right here on your desktop to let you know when it's been viewed. And if you were to click on this particular pop-up, it's going to take you to that presentation so you can see exactly what you talked about, you can make that call, and you can immediately strike. Now, another thing I do want to show you here is that your RateWatch actually runs down in your taskbar here. And you'll notice that the binoculars are green when there's good movement going on, and they're red when there's bad movement. So that's just an immediate indicator that you can use to determine where you're at in the market at any given time. So I would encourage everybody, if you do have the availability to download the desktop version, please do so. If you don't have the availability to do that because you're not an admin on your computer, contact IT, see if they can set it up, and in the meantime, make sure to visit the RateWatch site here at ratewatch.com/RateWatchOnline. So I know a lot of our members don't even know about this particular version of it, so I want to make sure you guys aren't missing out on what you can see here. Now, the next part I want to transition over to real quick is the commentary. Now, Dan, as you know, if you're a member, you've heard his commentary day in and day out, and it's just golden. It's the perfect way to start your morning. Grab a cup of coffee, listen to Dan, get educated on the market, and then get out there and fight the fight. But I do want to make you aware that there's other people in here that contribute, and there's a lot of different content that comes through. We have Bill Fisher, who does a weekly commentary, which is an audio commentary, and it's just weekly talking points, basically, but it's good stuff that you can digest and you can talk about with your clients. Neil Trineri actually does some really detailed metrics on what's going on, so you can double-click on any one of these, and it'll actually bring up that commentary. So you can see Neil puts out numbers, 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 and then he does give some advice towards the end. Now, oftentimes, and I should say usually the advice syncs up between all of our commentators, but sometimes you'll find a little bit of a difference, and that's, of course, just based on personality. But make sure to pay attention to these expert commentaries, because this is where you're really going to get the education that you need so you can deliver this to your clients. Now, we also do occasionally push through alerts to let you know that there's going to be a webinar. So these are important to monitor as well. Again, those will pop up in the RateWatch desktop app for you to let you know they're going through, and you get emails about them. So there's always a way to get this content. Now, there's an additional area in commentary, and that is the member commentary. So as members, you guys can all use this box here to actually type in chat. You can go back and forth with each other, and you can place lock or float votes. And you can see that several members have placed votes today. But it's a good place to be heard, good place to kind of banter back and forth and ask questions. Now, the final tab I do want to show you is our Lenders tab. Now, this one's pretty important. The Lenders tab is showing you an aggregate of the YSP movement, and obviously YSP doesn't really exist anymore, so it's an average rate movement across all of the rate sheets for this particular lender. And we can see that because of today, we've had of about 110 lenders that we track here, 88 of them have repriced for the worst today. And when we look back at the day watch chart and we see that we're, like Dan said, we're just kind of bouncing off 104, we're not really seeing anything that would look like we should be repricing for the worst. But we got to remember that gap down opening. So that's why it's so critical to listen to that video commentary in the beginning of the day, so you understand what happened overnight that could potentially have an effect on what rates are doing today. Now, you can actually set up any kind of, if you want to look at FHA, conforming, or jumbo rates, just remember that these are rate sheets for that companies all across the United States. So if they have rate sheets in California and New York, this is an average of all the rate sheet movement for that particular bank. Now, one more thing I want to point out to you, there's a My Lenders area. You can actually set which lenders you'd like to watch. So if you go into your settings area here, not only do you have the ability to set up your cell phone numbers. I mean, you can do all kinds of goodies here. You can you can set up email notifications, enable your commentary emails. You can set when you want to get static updates on the market. So when you put check boxes in here, it's going to send you an email and give you a pop-up update and let you know, hey, we're at +9 right now, or wherever we're at. But it'll just give you a static view of what the market's doing at any given time. But this is the part I wanted to show you. This is where you can select your lenders. So when you hit select lenders, this pops up another box that has all the lenders that we follow. And you can pick and choose which one of them you want to select. And all you have to do is literally left click on them, hit add lender, it becomes part of your list, and you hit OK. Now, once you submit that, that's saved. And you can now click on My Lenders, and it'll show you what your lenders did, the specific ones that you're watching. You can see what they've done over the day. And you can see only one of my lenders actually had any movement today, and it was actually positive. But definitely do set up your settings here. It's important that you get all the rounded knowledge you need, and that you can fine-tune it down to the specifics that you need. So I think that's pretty much all I want to show for this lenders tab here. I went through the settings for you briefly, but I want to encourage all of you. If you haven't been in the RateWatch yet, this is part of your membership. And if you're not a member, contact us for some info on getting a membership. Dave's going to give you a little bit of information on how you can do that in a couple of minutes here. But I want to pass it back to Dan for just a moment. Dan, if you can speak to just the all lenders, why are we seeing, and is this because of the gap opening? Why are we seeing a majority of these lenders doing this worse pricing today?
Yeah, you nailed it. It has really little to do with what's happened today. It has mostly to do with what happened between yesterday and today. Because most people closed out at a certain price, they opened up, they said, "Whoa, look at it, it's really dropped," and then they priced. The times of the day I can't speak to. Some desks are faster than others, but you can see just scrolling through these. Most of them happened early this morning when they first released their rates.
That's a great point, actually. You have a slider down here that you can check and see exactly when everybody repriced. So you can see at 10 a.m. today, most of those reprices were early, like Dan said. I would imagine if we go even earlier, we find out when the lock desks open.
Yeah, pretty much.
Now, with that said, Dave Savage, if I can pass it back to you, I know there's a couple of wrap-up items that you'd like to cover. And Dan, I want to thank you so much. Huge value today. And I really appreciate the insight just on a personal level, and I know our members did as well. But Dave, if you would, go ahead.
Yeah, well, so Dan,
hey.
go ahead, Dan.
Go ahead, Dave. I just wanted to see if you needed me further, or if I can head out to my meeting.
You can jump out to your meeting, Dan, and we're grateful for the contributions that you provide on a daily basis for so many years, and let's you and I catch up soon.
Okay, and then if people have questions, if they want to email them, I'll answer all of them.
All right, and then also, folks, with any questions, you can post them on our Facebook page, and we'll get back to you on that. But I just want to remind you that not only are these insights available on your desktop, and if you can't install the desktop app, Jacob showed you how to do that on the web app, they all come through on the mobile device. So make sure you put your mobile phone number in, make sure you have your email address. You can access these alerts on your mobile. I want to remind everybody we are here to help you guys. So every Tuesday at 9 o'clock, we're doing a coaching call. Every Thursday at 9 o'clock, we're doing a training. Jacob did that this morning. And if you haven't created 5 or 10 total cost analysis yet, come to the basic program every Fridays at 9 o'clock. You should be getting these emails from us. If you're not, make sure that you approve us and you're not getting caught up in your spam filter. Anybody who is listening to this right now and you don't have access to Edge, or you're with your sales manager and you're a non-member of Mortgage Coach, you're with a friend who's a peer that's a Mortgage Coach member, again, we're delivering huge value for not only home buyers but for realtors. So make an informed decision. Just go to our website at mortgagecoach.com, click for a personal demo. And if you want to raise your hand right now, let us know if you'd like to know more about Mortgage Coach. Just click yes, and we'll make sure someone reaches out to you. So, Jacob, I don't know if you have any more key takeaways. I have a few more comments and thoughts, but any thoughts that you have before we wrap up today's call?
Well, I do want to mention that on today's Thursday training call, we went through how to drill down your purchases. Cut and dry, just nuts and bolts of how to put down purchase presentations inside Edge, what to do with them. We demonstrated the MCC credit if you guys are interested in learning about how to use that inside Edge. And as Dave showed earlier, we archive every one of those calls. So all you have to do is go to the mortgagecoach.com page, hover your mouse over the community tab, and choose the coaching call archive. And you can get all the detail that we've been discussing over the last weeks. And I encourage everybody, please do show up for not only the Thursday sessions I run, the Friday beginner sessions if you're brand new, and the Tuesday sales calls. I mean, the best sales meeting in the industry, Dave Savage and a guest every Tuesday. So make sure to attend those if you possibly have the chance. And if you can't, we've got them recorded for you. So feel free to watch those on our YouTube or in our coaching call archive.
All right. So I hope today's call was great. Hopefully everybody on this call has already downloaded the Mortgage Coach mobile app. Go to your app store, whether you have an Android device or an iOS Apple device. Make sure you've downloaded the free Mortgage Coach app so that you can deliver that conversation to realtors. You can help homebuyers make better decisions. Grateful to Dan and everybody. Have a fantastic week. Hopefully we'll see you next Tuesday. We'll see you next Thursday. And Jacob, I'll let you say the final words.
All right. Well, thank you, everyone, for attending today. We appreciate you being part of this community, making it better for all these homeowners out there that they need the American dream. You guys are the ones to deliver it, and we are incredibly grateful for you. Please feel free to email us at support@mortgagecoach.com if you guys have any questions, or if you'd like additional tour. If you're a non-member right now and you'd like to see a little bit more about it and you didn't raise your hand a moment ago, just shoot us a quick note over at support. We'll get somebody in touch with you. Thank you, everyone. Have a wonderful day, and hope to see you on the future calls.